However, I feel by the end of this year, investors in general will have pain to deal with. My personal opinion is I remain basically bearish on this market. I feel that the highs are close to being in. It might jump a little higher. However, I feel by the end of this year, investors in general will have pain to deal with. Where does that pain come from? Well, one place is that if the Fed never pivots, in other words, they just hold maybe rates steady, or they even raise them again. Today's inflation report, I think everybody noticed, was a little bit milder. However, that was the core number. How the inflation still remains, however, because the the oil markets, which they consider the volatile and it's not part of the core inflation, have risen over the last 3 months. I think we might be noticing that all around the country, no matter where you're at. Guess is prices have stabilized and they have been creeping higher. Going forward, when you look at the breadth of the market, when you look at the amount of credit card expansion, let's talk a little bit about that credit card expansion. The reason why America seems and corporate profits have come in generally okay is because there is so much money that was sloshing around the system that was given away by the US government, the $6 trillion that the government spent since this administration took over to either battle COVID and or help businesses. It is still out there. It is in the hands of the consumers. And the American consumer can be counted on to do one thing: spend. They love to buy. I love to buy, but it doesn't matter. At some point, you do run out of cash. And when you do, it doesn't mean your habit is stopped. It means you might look elsewhere to buy that same thing. That is why their credit card debt is expanding. The other thing we're noticing is credit card defaults are also expanding. So debt is rising. When debt is rising, generally you feel that the people are healthy because they're willing to have the debt because they expect to have their job. However, there is more and more defaults. So you can't talk about one without mentioning the other. And I see a lot of pundits doing that. That tells me that we have counter trends going on in terms of credit. We're borrowing more. That's why credit card growth is expanding, the debt there. And they're also paying less. They're defaulting on much of their spending. So those two things seem to contradict each other. So I call that kind of a wash. I don't think that debt spending and debt growth is really necessarily good for this particular market. We also have some huge burdens in front of us. We'll probably talk about in a few more minutes. When you know what they are, it is the debt ceiling. It is the fact now that we have definitely a little bit more chaos going on inside of government that is extremely dangerous. We know this has been going on for a long time. The market definitely loves inaction, or what they call gridlock. However, this is not just gridlock. This could be reaching a boiling point. These things, like, have you ever heard the saying, people, that a watched pot never boils? That is what I think is happening here. I think a lot of people are expecting the market to go lower. And they keep watching and seeing what day is this going to begin, and it just doesn't seem to begin. It will always begin when you take your eye off of it. Right now, we see that the markets are kind of hanging in there, but they're only hanging in there because, again, of a very short list of technology stocks. And to me, just because technology is rising doesn't mean we have a healthy economy. So for me, in general, I believe the best course of action is to remain firm, stand pat, keep your cash tight to the vest. There is going to be a time to deeply invest in the market. However, it isn't now, and it will be later. And that is the hardest part: patience. Because again, we keep seeing these markets trying to go higher, but they're just being dragged. They're not buoyant. They're just being dragged up.
Right. So it's kind of like the indices are showing a positive performance for the year because there's just a few heavyweight, really impactful large cap stocks that are dragging everyone else up along with it. But it's just I feel like it's just a matter of time before it gives out. Right. The weight becomes too much.
Exactly. And let me give you another example of what it is. Here's another stock that everybody knows. It's Goldman Sachs. It's a bank. We all know the banking sector has issues. However, this is by all standards the best of the best in terms of banking. Well, Goldman Sachs this year is down on the year. For such a strong market, why is the fundamental leader in banking down on the year? We can say that too if we look at here, we can look at Bank of America. That doesn't look very friendly from January this year. The banking sector is in trouble. We all understand why. We know it's the regional banks that have caused a lot of the concerns that we have about our deposits. But generally, you do not have a good economy if the banking sector is trying to go lower. And right now, we see this. It doesn't mean it's not a good buy for the future. However, these are the kind of things that are going down in the major indices, and they're only being disguised by, again, that very few group of stocks that have done very well. And here's one of them, good old Microsoft. New high today, and look where they've come from the beginning of the year. These things, in most cases, are beyond their normal extensions of a rally. At some point, these things will decline in mass. And when they do, they're going to take the whole market down. The rest of the market's already weak. When these stocks weaken, and they weaken when interest rates either go a little higher or they don't just go down. In other words, if interest rates stay here, then the price is it's already priced in, and the market knows it. If the Fed starts to cut, well, they also know it. That's after the fact. So I kind of feel that, again, my personal opinion, which is not a reflection of Flip, is that these markets are probably soon to find a correction. And when they do, they're going to drag the overall indices lower. I believe they will drag the Dow Jones down in the year as well as the S&P 500. And that is at a minimum 7% correction in the market.